Hi, this is Marie from Legacy Publishing. In today's video, we are going to explore investing in emerging market equity markets. Chuck, can you tell us about the profit potential going forward investing in emerging markets?
Marie, my technical analysis reveals that emerging markets are currently on a buy signal. This price graph for the emerging markets ETF shows that this market is in a confirmed uptrend as indicated by the ETF price trending up and the on-balance volume line also trending up, which indicates volume is increasing on days the ETF closes up and volume is decreasing on days the ETF closes down, confirming the price uptrend can be sustained. My fundamental analysis also shows strong growth in emerging market economies. Here is just a sample of some of the many growth stories for the emerging market economies. The ISI Group researchers reported that China's third quarter gross domestic product grew at a 12% quarter-over-quarter rate. Korea's economy grew at around an 8.2% rate. McDonald's Corp. Sales in China were up 30% in the latest quarter. China retail sales are up 24% in the past 9 months. And China industrial production is up 21% in the last 10 months. So my fundamental and technical analysis reveals that the best profit opportunities available today are in the emerging markets. This table compares the profit performance for 7 global stock markets during the 2003 through 2007 bull market and during the current bull market. The Brazil emerging market, China, and the Europe, Australia, and Far East foreign stock markets outperformed the 3 U.S. markets listed here during the current bull market and during the 2003 through 2007 bull market. Notice how the 1 through 7 relative performance rankings during the 2003 through 2007 bull market did not change during the current bull market, with Brazil retaining the number 1 ranking and the S&P 500 index retaining the lowest number 7 ranking. So if the current bull market in emerging markets lasts as long as the 2003 through 2007 bull market, there are still great profit opportunities ahead investing in the emerging markets.
Chuck, how can investors participate in the profit opportunities available in the emerging market stock markets?
Marie, I have been purchasing call options and option spreads and initiating buy-right trades on the Brazil, China, and emerging market ETFs. Here's an example of a recent call option purchase I made for the emerging markets ETF. My brokerage confirmation shows that I purchased the emerging markets June 28 strike call option for 12.20 points. This option expires in about 7 months. The emerging markets ETF was trading at $39.82 when I purchased this option. In my high accuracy option trading report, I recommend a simple formula for selecting option strike prices for high accuracy option trading. Now I use this formula to select the strike price for this option. This call option purchase analysis displays the profit loss potential for buying the emerging markets June 28 strike call option at $12.20. The analysis displays the profit potential for this call option purchase, assuming various price changes for the emerging markets ETF at option expiration from a 30% increase in price to a 5% decline in price. We can see from this call option purchase analysis that the time value for this option is 0.38 points and the intrinsic value is 11.82 points. The emerging markets ETF only has to increase 0.38 points or less than 1% over the next 7 months for this trade to become profitable. Now, when you purchase an option, the time value portion of an option is a decaying asset. Options lose all time value at option expiration. Therefore, the goal is to maximize intrinsic value and minimize time value when you purchase an option. The best way to achieve this goal is to purchase an in-the-money option with low time value. There is a much higher probability that an in-the-money option purchase with a 1% break-even price will be profitable compared to an out-of-the-money option that would require a 10 or 20% or even higher price increase in the ETF in order to break even. Trading in-the-money options allows you to increase the accuracy of your options trading compared to out-of-the-money options. Now, smaller accounts can trade ETF option spreads. My brokerage account confirmation shows that I purchased the emerging market January 30 strike call option at 1308 and sold the January 40 strike call option at 648, creating an option spread. I took this option spread trade after I recommended the trade to the members of my GPS advisory service. This call option spread analysis displays the profit potential for the emerging market ETF 30 strike, 40 strike call option spread. The cost of this spread is $660. The analysis displays the profit potential for this option spread trade, assuming various price changes for the underlying emerging market ETF at option expiration, from a 20% increase in price to a 10% decline in price. If the emerging market ETF increases in price, a 51% return would be realized before commissions. And if the emerging market ETF remains flat, a 51% return would also be realized, and a 10% decline in price results in a 15% return. So trading option spreads is a good way for smaller trading accounts to participate in the profit potential for emerging market ETFs. So to summarize, my fundamental and technical analysis reveals that investing in the emerging market ETFs and options can result in tremendous profits over the next several years. I plan to maintain my emerging market positions over the next several years, as I am a firm believer in the strong growth potential in the emerging markets.
Well, Chuck, it appears that the emerging markets have a great future, and I hope our viewers were able to gain some valuable insights into taking advantage of the profit opportunities available investing in emerging markets. I want to thank everyone for viewing, and I am looking forward to our next presentation.